Supply and Demand Trading Strategy, a beginner's guide. Welcome to this beginner-focused guide on the supply and demand trading strategy. If you're new to trading and eager to understand how the dynamics of supply and demand drive market movements, you're in the right place. This strategy is one of the most effective tools for reading charts and making informed trading decisions. Together, we'll explore how supply and demand zones are formed, how to identify them, and how to use this knowledge in your trading journey. Let's get started. Before diving into the strategy, let's break down the fundamentals. Supply and demand are economic principles governing most markets, including the financial markets. Supply refers to how much of a commodity, stock, or currency is available for sale, while demand refers to how much buyers are willing to purchase. In trading, price movements are a result of the tug-of-war between buyers and sellers. When demand overpowers supply, prices rise. Conversely, when supply exceeds demand, prices fall. By understanding where these imbalances occur, traders can identify potential price turning points. The interplay between supply and demand provides valuable clues about future price movements. It helps traders pinpoint zones where the market is likely to reverse, decrease, or pick up momentum. Recognizing these zones equips traders with the ability to make better entry and exit decisions, manage risk effectively, and improve overall profitability. As a beginner trader, understanding these zones will introduce you to price action trading, a technique that doesn't rely solely on complex indicators. It provides a clearer picture of how the market behaves. A supply zone is an area on the chart where selling pressure exceeds buying interest, causing prices to fall. These zones often appear after sharp upward movements when many traders decide to sell and take profits. Price reaches a peak and then declines suddenly. The zone often acts as resistance, preventing prices from rising further. These zones are often formed during periods of high market activity, like during significant news releases or economic reports. For a beginner, marking out supply zones simplifies the process of identifying where a market's upward trend could halt or reverse. A demand zone is the opposite. It represents an area on the chart where buying pressure outweighs supply, pushing prices higher. Demand zones emerge following sharp downward moves when buyers step in, creating a floor that prevents prices from falling further. Price reaches a low point and reverses upward quickly. The zone often acts as support, preventing further drops. These zones are often linked to major events or news that spur buyer interest. For beginners, demand zones are key to spotting potential buying opportunities and establishing trade entries. Candlestick charts are one of the most effective tools for spotting supply and demand zones. The distinctive open, high, low, and close of candles tell a story about buyer and seller interactions within a period. Key candlestick patterns like engulfing candles or doji formations can give traders insights into where supply or demand zones are forming. Throughout this video, you'll learn how to use these tools to your benefit. Let's walk through the process of finding these zones on a chart. The first step is identifying areas where prices have surged up or rapidly dropped. These moves indicate an imbalance between buyers and sellers, signaling a supply or demand zone. Mark areas around the peak, supply, or base demand. These should be horizontal lines or rectangles that encompass the price range where the movement occurred. Not all price movements result in valid supply or demand zones. Look for evidence such as sharp reversals occurring after the zone is first tested, multiple instances of price bouncing off or stalling near the zone. By following these steps, you'll clearly map out potential trading opportunities. Supply and demand zones serve as excellent references for trade entries. Here's how you can approach them. Supply zone example. When price returns to a previously identified supply zone, this might be a good point to enter a short-sell trade. The assumption is that selling pressure will once again dominate, causing prices to drop. Demand zone example. When price revisits a demand zone, this could signal a buying opportunity. The market tends to react by rallying upward due to renewed buying pressure. This method is simple and helps you avoid buying or selling in less advantageous areas of the chart. Using supply and demand zones can also inform your stop loss and take profit levels. Stop loss placement. Place your stop loss just outside the zone boundary. If price breaches your zone completely, it's a sign the imbalance may no longer hold. Take profit placement. For supply zones, set take profit just before the next demand zone. For demand zones, aim for a point just before the next supply zone. This approach allows you to minimize your risk while maximizing potential gains. One challenge when using supply and demand zones is avoiding false breakouts, where price temporarily moves beyond a zone before snapping back in the opposite direction. Here are ways to handle these situations. Wait for price confirmation, such as additional candlestick patterns signaling reversal. Watch trading volume. High volume near your zone reinforces its strength. By exercising patience, you can avoid acting on false signals. As a beginner, it's important to be aware of common mistakes. Overcomplicating analysis. Keep your zone markings neat and clear. Avoid cluttering your chart with unnecessary lines. Ignoring market context. Consider external factors such as news or the broader market trend when evaluating zones. Emotional trading. Don't place trades purely out of fear or excitement. Stick to your identified zones and strategies. Mastering supply and demand takes time, but avoiding these pitfalls will accelerate your learning curve. Imagine a stock surges upward, reaching $150 before reversing sharply down to $140. Drawing a supply zone from $148 to $150 highlights a resistance area. If price later approaches this level again, it's likely to face selling pressure. Consider a Forex pair dropping to $1.10 before bouncing upward to $1.12, marking a demand zone between $1.098 and $1.102 would highlight an area where buyer interest is strong. Future returns to this level could present buying opportunities. Supply and demand zones behave differently depending on market trends. Trending markets. Zones help confirm the direction of a trend. For example, in an uptrend, demand zones are more reliable for entering long buy trades. Ranging markets. Zones are useful for identifying range boundaries, where resistance acts as supply and support acts as demand. Adapting to the market's current behavior ensures you're applying the strategy effectively. Several trading platforms offer tools to assist with spotting supply and demand zones. Analytical software like TradingView or MetaTrader can make drawing these zones easier by offering advanced indicators or auto-detection functions. For beginners, these tools eliminate guesswork and save time. Before applying this strategy in live trading, practice using historical data. Pick a chart and identify zones based on past price movements. Track how price behaved the next time it revisited those zones. Look for patterns and refine your ability to recognize valid zones. Backtesting builds confidence and lets you spot potential weaknesses in your approach. Confidence comes from consistent practice. Don't feel discouraged by mistakes. They are part of the learning process. Over time, with better understanding, you'll find yourself instinctively recognizing key zones and making informed decisions. Let's look at a case study. Scenario: a Forex pair EUR-USD rallies to 1.200 before dropping to 1.180. Around 1.200 sellers consistently dominate, forming a supply zone. Execution: you mark this as a potential shorting opportunity. When price returns to 1.200 weeks later, you enter a sell trade, setting a stop loss slightly above at 1.205 and a take profit at 1.185. Result: all things being equal, the market should now drop towards your take profit zone. This example demonstrates the practical, straightforward application of supply and demand zones. To recap, supply zones show where selling pressure outweighs buying, causing price drops. Demand zones represent buying pressure that pushes prices higher. Properly identifying and marking these zones is key to executing informed trades. When approached correctly, the supply and demand trading strategy provides a robust framework for market analysis. It's one of the simplest, most beginner-friendly ways to start reading charts effectively. Ready to put this strategy into action? Start by practicing on historical data or a demo trading account. Use what you've learned today to identify supply and demand zones. Practice marking them and experiment with entry and exit points. Over time, this will build your confidence in applying the strategy consistently. The financial markets can feel overwhelming at first, but by focusing on a strategy like supply and demand, you'll be empowering yourself to think strategically. Stay patient, practice regularly, and remember, you're on a journey to becoming a successful trader. Keep at it and you'll see the results unfold. Happy trading!